Well, thank you, Amy, and good morning, everyone. Thanks for taking the time to join us today, and welcome back to our economic and market update. I say welcome back because we attempted to do this about a week and a half ago, but the Florida hurricanes disrupted our technology. So we're giving it another attempt today. And the good news is that Jeffrey Kleintop, who is the managing director and chief global investment strategist at Charles Schwab, is back again today to join us. And the second part of the good news is I think our technology is in good shape and ready to roll. So as Amy said, I do encourage you to use the Q&A feature of the platform. We'll be spending the second half of our time today or so answering the questions that you submit. So I encourage you to do that. And with that, Jeffrey, I'll turn it over to you and let you take it from here.
Thanks so much, Brad, and thanks everybody for a second chance here. Yeah, hopefully no storm coming through today, so we'll remain connected, and I'll share my thoughts with you. I've got a lot of thoughts to share. I mean, there's just no shortage of things going on right now in the markets and in the economy, politically, you name it, right? So there's no way I'm probably going to cover everything on your mind. So please get your questions in. Feel free to submit those at any time. We'll get to those later. I want to leave plenty of time for that. But I've got probably at least a half hour of prepared thoughts for you, accompanied by some charts, some data, some information, because I think a picture goes a long way sometimes in explaining what's happening. So I'm going to go through a lot of those details. I want to talk about first the environment that we're in, the recession, the bear market, what's going on with that. Where are we in it? Is it just starting? Is it ending? What's going on there? And then where are we with regard to inflation? Inflation's the driver of all of this. It's been the biggest factor affecting the markets here and abroad this year. And then turn to central banks like the Fed. What are they doing about inflation? We know they're raising rates. Are they done? Are they close to being done? Have they still got a long way to go? And what does that mean for the economy and markets? And then finally, what are some ideas? What's working in this environment? And how can we think about investing in this kind of environment? And then the transition to what's next? You know, what's over the horizon? And how do we think about that? So I want to kind of bring all that together. Obviously, we're here in late November. We've got, turkeys and cranberries and stuffing on our minds, but there's still a lot to the remainder of this year that I want to focus on too in terms of what we're looking for. So let me start out with this. I guess I'll call it Recession Watch. We are, I think, have started a global recession. I think it started probably in September. I'll talk about why I think that's the case. But I want to talk a little bit about some of my favorite indicators and why I think, despite, we went into a midterm election season where there was a lot of debate. Are we in a recession? Are we not in a recession? Because we know the economy and the markets tend to have a big impact on political outcomes, much more so than political outcomes have an effect on the markets and the economy. It definitely drives one way more than it drives the other. And so this concern about inflation and recession was a factor. This is probably the best indicator of when we're going to head into a recession that there's ever been. This is the yield curve. You probably heard about the yield curve. It's gotten a lot of attention lately. I learned about it in college in the 80s. I've still used it very consistently. What it is it's the difference between short and long-term interest rates. Usually short-term rates are below long-term rates. 3-month CD rate is usually a lot lower than a 30-year mortgage, but not always, right? Sometimes that flips, and because of inflation and because of rising interest rates in the short term and because of less demand for long-term investment, they invert and short-term rates rise above long-term rates. Very rare when that happens, but the line on this chart indicates when it does. This is the percentage of portions of the yield curve that are inverted. So there isn't just one yield curve. I just said 3-month to 30-year. That's one way of looking at it. Bond people tend to like to look at the 2-year versus the 10-year yield. The Fed historically has liked to look at the 3-month versus the 10-year. And even more recently, Chairman Powell has expressed an appreciation for the 3-month to 18-month portion of the yield curve, all these different maturities and where are they in relation to each other. I don't get involved in which is the favorite. I look at them all. There are 91 different ways you can slice and dice shorter versus longer maturities. And this is the percentage in blue that are inverted. And right now we're nearly 70% of the yield curve, meaning most of those 91 different durations on the yield curve are the shorter ones are above the longer ones. Nearly the entire curve is inverted. And what you can see here is looking back, whenever we've gotten over 50%, it's been followed by or coincides with a gray column. Those gray columns are recessions, periods where the economy loses output, where we lose jobs, where profits fall and stocks tend to fall anywhere from 20 to 50%. So we want to watch out for those periods of time. They're bad news. And this is a great indicator that lets us know, it doesn't cause it, but it's an indicator there's an imbalance in the economy. We saw that in late 2019, signaling risk of a shock in 2020. Of course, we got that in the form of a pandemic, but looking back, it's never failed. Whenever this is over 50% of the yield curve inverted, we get a recession or we're in one. And I think we just haven't shaded it yet because it hasn't yet been declared by the National Bureau of Economic Research that dates recessions in the US. They only do that pretty much after they're over. They go back and go, oh yeah, the recession was from here to here. They don't do it in real time. And so that's why it's still a little bit of a question of when it actually began, though I think there's little doubt that we're actually in one right now. This would point to the fact that we are very probably in one right now, based on the best signal that we've seen, a perfect track record of predicting recessions for 50 years. Another one of my favorite indicators of recession, is this. It is the global leading economic indicator. It is one number that captures all the leading indicators of economic activity in the world. 40 different countries accounting for almost 90% of GDP are captured in this. And whenever this line, this is an index produced by the Organization for Economic Cooperation and Development, the OECD. You may have heard of it. It's a big global think tank. Been around many decades. This is their global economic indicator. I drew that dotted line at 99 because whenever it's dropped below 99, we've got one of those gray columns, which we now know are recessions, right? A couple times it did a double dip, like in those early 90s, the early 90s there, and the early 2000s. Started to come out of a recession, fell back in again, maybe came back, kind of a false start. But other than that, whenever we've dropped for the first time down below 99, we've gotten a recession. We're there now. And so I think this is another signal that not just the US, but the globe has probably entered a recession. This happened this summer. And one more of these, another favorite indicator, the PMI, the Purchasing Managers Index. This is a survey of leaders at 27,000 businesses around the world. Many different components to this survey. What are your orders looking like? Inventories, pricing, production, all these types of things. They're scored together. And whenever this drops below 50, that's the dividing line. And I just zoomed in the last 20 or so years here. Whenever it's below 50, it indicates a recession. And we're there, but only barely. If you'll notice on this chart, the one before, and even the yield curve chart, it's not dramatic. We're not looking at a deep economic downturn here. We're referring to this as kind of a rolling recession, meaning that different parts of the economy and different countries are going into recession at different times. And that's in contrast to what we saw in 2020 or 2008, 2009, which I'd call the everything, everywhere, all at once recessions, where literally just everything dropped at the same time. And it was very obvious we were in a downturn, and then pretty obvious when we were coming back out as well. It's not as clear this time. Right now, what we heard last week from Kohl's and Target and others is that consumers aren't doing well, and sales are weak, and inventories are high, and they're trying to clear inventories, aggressive discounting to try and clear merchandise heading into the all-important holiday shopping season that kicks off on Friday. Yet, in production, as a result, like manufacturing here, the making of goods is in a downturn because orders are down and inventories are up. But try and book an airline ticket, right? Try and fly home for the holidays. Very difficult to do. There's a lot of travel going on right now. I live 3 miles from Disney's Magic Kingdom here at Walt Disney World. try and get in line at Magic Kingdom right now for Space Mountain. It's like an hour and a half long. Forget about it. So services are doing really well. No recession in services right now. Restaurants, airlines, hotels, theme parks, you name it. But shopping, for clothing, for furniture, for used cars, way down, and prices are falling. So it's a different kind of recession, kind of a rolling recession right now, and a bit more shallow as a result than maybe what we saw in the last two very deep dips that you see on this chart. Nothing like that. Obviously, this is probably going to get a little deeper than it is now, but still think it's probably going to end up as a much more shallow recession, again, with different parts of the economy, different countries around the world rolling through recession at different times. So it's relatively good news in terms of how maybe deep the stock market decline needs to go. Maybe we've already seen some of the worst of that. But it is obvious to the stock market that we're in a recession and bear market. This is just one of my favorite charts I've updated for many years. It's telling us that every single major place we can invest is in a bear market right now. Stocks in a bear market. They fell more than 20% from their peak. Yeah, they've recovered a bit, but still the S&P 500, I'm looking at my screen, is down 17.4% this year. Bonds, yeah, worst year for bonds in 50 years. Bonds with interest rates are rising. Bond prices are falling, and it's been one of the worst bond markets we've seen in a very long time. And even cash, on an inflation-adjusted basis, you're losing ground in cash. So it's very rare that stocks, bonds, and cash are in a bear market at the same time, along with gold and commodities and cryptocurrencies and NFTs and right. I mean, it's just been across the board. Very rare. Back in the 70s, there were two periods during the 1970s where this also happened. Those are the only other times in 50 years where we've seen all these asset classes in a bear market at the same time. Usually it doesn't last long. Lasts about 9 months to 12 months, and then kind of one of them at least gives way, and we tend to see a recovery, and hoping that we're near the end of this bear market in both stocks, bonds, and cash, and begin to see some improvement. Maybe already we've started to see some of that here with bond yields having retreated somewhat and stocks having rebounded off of their lows. But there's probably still some volatility ahead. One of the challenges of a rolling recession is you're never quite sure when you're out of it, right? Because different things going in at different times. So I think the volatility we've seen over the last 5 months, every month we've seen a swing of 5% or more in the stock market, not just down, but up as well, might continue in the months ahead, maybe the next few months. Still a lot of volatility as we kind of test the lows and begin to form a basis for recovery. But I don't think you need to worry about how much lower is the stock market going to go? What day is it going to bottom? What week or what month? Because I think there's some very important changes taking place in relative performance inside the markets that are way more important than when the overall market bottoms. I know it may feel like, wow, my portfolio is tied to the overall market. I know, I get that. But if you've got a really diversified portfolio, then there are parts of your portfolio that are actually working really well right now. And I think just recognizing that is probably more important than worrying about where the low is. Let me show you what I mean. And I'm going to go from talking about bears to sharks. This is one of my famous, maybe we'll call them infamous, shark charts here. And what I'm trying to represent here, the use of the shark, is that the jaws are wide open right now. And that represents a risk and a danger to investors who maybe haven't rebalanced their portfolio. You know, a lot of investors left to their own devices who maybe don't have the benefit of a professional investment advice tend to not rebalance, tend to not sell high and buy low. And now is a really important time to do that, because I think the risk is very high that those jaws begin to clamp down. And if you look at these two lines, the blue line is when it's going up, international stocks are outperforming US stocks. And when the orange line is going up, US stocks are outperforming international stocks. They're really just mirror images of each other. There's ratios. The top one is the EFI index divided by the USA index, EFI being the international developed markets. So let me take you back here and try and share the idea that every cycle, the recessions here, I shaded them gray before. Remember, I shaded them blue this time because the shark's gray. I just wanted them to show up. Same recessions, same periods of time. But if you look back, between every one of those recessions, we saw different leadership in the market. Literally every time, going back decades and decades and decades, every single cycle, if international outperformed, The next cycle, US outperforms. The next cycle, international. The next cycle, US. The next cycle, international. Let me show you what I mean. Back in the 80s, that huge run up in the blue line is international stocks outperforming, led by Japan. Incredible outperformance by international stocks, and US really didn't do that well in the 80s. They didn't lose ground. They still, posted gains, but nowhere near the gains we saw in international stocks. But then the 90s, after we got that 1990-91 recession, the game shifted. US stocks began to really come back. And any investors who didn't rebalance their portfolio back towards US stocks after incredible international outperformance really got a bite taken out of their portfolio, because we really saw real crossovers. International stock performance slumped and US stocks really did well in the 90s. It was all about tech stocks, right? The dot-com boom. Then we got to the next recession in 2000, 2001. And from then until 2008, international stocks outperformed again, not by the same margin they did in the 80s, but they outperformed pretty significantly. And again, rebalancing would have been smart, back from the US to international. And then in 2008, 2009, that recession, it flipped again. And we saw big US stock market outperformance on incredible liquidity-driven gains as the Fed and the federal government pumped a lot of money into the economy, a lot of that spilling into the stock market and driving incredible outperformance. Now, look at that skinny, very skinny blue line towards the end there. That's the 2020 recession. It was 2 months long. And I thought, I was wrong. I thought that was going to cause the jaws to begin to close again. Back then, we were right about where they were, where international stocks had outperformed US stocks by that same margin as we were back in the late 80s. I thought, yep, we're about to see the jaws begin to close. And international stocks are about to begin to outperform. They did for about 6 months or so. Then we saw an enormous amount of stimulus. After just a little 2-month recession, the Fed poured so much money into the economy, and so did the federal government, mailing checks to everybody, that the liquidity-driven run-up in tech stocks just continued. It just exploded and got a second wave, a second wind, and those jaws stretched even wider. This is a very different recession that's starting right now. Liquidity is being drained from the markets. We've already felt it in tech stocks and the most liquidity sensitive parts of the market, like crypto, which have absolutely crashed. And at the same time, we've started to see better performance by international stocks. In fact, year to date, international stocks are outperforming US stocks by a tiny margin, but it's starting to happen. Part of the reason that you can barely see anything on this chart is because the dollar is up 12% this year. And that is masking underneath outperformance by international stocks by more than 10 percentage points this year, if we just look at the indices. But when we translate those gains in pounds and yens and euros back into dollars, well, they translate into fewer dollars. And so that means they're neck and neck this year. International stocks only outperforming by 0.5 percentage point. You can barely see it on this chart, but it started. I think we started to see the jaws begin to close. And over the next year or 2, 3, over the entire next cycle, which could be another 10 years, who knows, we could see international stocks, that blue line, begin to hook back up and outperform. So I think having a diversified portfolio, it's been tough for the last 12 years, right? All you needed to own was a handful of US tech stocks and did great. That's rare, right? And we're now starting to see a reversal where those are going to underperform. And this is a hard thing for most investors, because when we start to get into difficult markets like we've had this year, they tend to focus on the stocks that got them here. They tend to sell everything in their portfolio that hadn't been working in recent years, like international and value stocks and energy and all that stuff, and just focus on those stocks that had done really well. The problem is those aren't going to be the ones that rebound this time. What we're seeing is better performance out of international stocks, out of value-oriented stocks, and not those liquidity-driven US tech stocks that really were the leaders over the last 12 years or so. And in fact, I can show you that in another shark chart, my last shark chart, this one here, which is the difference between growth and value stocks. Growth stocks are like tech stocks, right? Their earnings are way out in the future. They're growing them very rapidly, whereas value stocks, maybe more of their earnings are today. They don't grow them as rapidly into the future, but they trade at a cheaper price to earnings ratio. So what you see here is when the orange line is going up, that's when value stocks are outperforming. And when the blue line is going up, that's when growth stocks are outperforming. And what you'll notice here is that we've kind of got this environment now where we're already starting to see the jaws begin to close. Growth stocks in blue have already started to pull back, and value stocks have started to turn around. And the reason this one's more obvious that the jaws are starting to close is because both lines are measured in dollars here. And so you can see without the effect of the currency of that 12% boost to US performance, that's now starting to fade because the dollar's starting to fade a little bit. You can already see those jaws starting to close. So again, international and more value-oriented parts of the market, short duration stocks, lower price to earnings ratio stocks, high dividend paying stocks have really been the winners here in this market. I think will continue to be, not just for the remainder of this bear market, but well throughout the next whole cycle, which could be 5 to 10 years. So I think recognizing these reversals that are already happening is more important than trying to pick the day the stock market bottoms, right? We're already seeing the shift to new leadership in the market. It's already taken place. And in some cases, looking at high dividend paying stocks, they're basically flat this year. Versus companies that don't pay a dividend, growth stocks are not. They're down quite substantially. So we're already starting to see this rotation happen. I think that's more important than the fact that what day is the recession over, or what date is the bear market bottom. So I probably beat that to death, but I think it's a really important theme that I think so many investors miss. Already we're seeing market leadership begin to emerge. That's very positive. So let me talk a bit for a second here about inflation, because that's what's driving all this. Where are we headed on inflation? Has it already peaked, or is there more yet to come? Well, the thing about inflation is it's a process. Not all prices peak at the same time, right? Usually it's energy or commodities first, oil, metals, agriculture. Then a few months later, goods prices, furniture, clothing tend to peak out and begin to come down. Then a few months later, services like healthcare and education and housing peak out. But it's not even in terms of how much of what we buy is tied to these different categories. Only 8% of the consumer price index, CPI, is tied to energy and commodities. The good news is they peaked out in June. Oil is down substantially. It was $130 in June a barrel. Looking at my screen right now, $78.39. Come down dramatically. So is copper and aluminum. So is wheat. I mean, wheat was a big product of Ukraine. And so it soared in price. Prices for wheat globally are now below where they were prior to Russia's invasion of Ukraine. So all those commodity prices have come down. And, that started in June. And then somewhere around September, we started to see August, September, goods prices begin to come down. Furniture, apparel, used cars. Every month in the CPI report for the last 3 or 4 months, we've seen those categories begin to come down. Retailers and manufacturers have the most inventory they've ever had. We just heard that through the earnings season. They don't know what to do with this stuff. In fact, Prologis, which is a warehousing company, big company, they do warehousing primarily for retailers, meaning they hold the stuff until it's needed on store shelves. They have no vacancy. They're absolutely stuffed to capacity. Stores have no room to place this stuff. They are trying. Last year, right? Remember, stores were like empty when you were trying to shop for the holidays. Not true this year. They're stuff spilling out into the aisles. They're trying to get rid of it all. Goods prices have been falling in recent months. So this has worked. We've gone from energy and commodities to goods, but that's still only about 40% of inflation. And it's why, though it's come down a little, it's still too high. The reason is services. Yeah, education and healthcare, those prices never really come down. But they're a small portion of services. 40% of that 57% that is tied to services is housing. It's our houses. It's where we live. That's the biggest portion of inflation. Now, the way we measure it, well, it's not home prices. You might think it is, but it's not. In fact, if it were home prices, they'd be plunging. But they're not. Look, home prices have been coming down. This is housing activity. So this is home sales across different countries from their post-pandemic peak. In the US, they're down 25%, meaning just not, things have really slowed as mortgage rates have gone up, right? But look at Australia and Canada. Housing activity there is down over 60%. I mean, just massively hit by the rise in mortgage rates in those economies. But it's true in the UK, New Zealand, Sweden, all over. We're seeing this. And Really, really dramatic moves here. But the way we measure inflation isn't on home prices. It's actually, I'm going to show you here, it's based on this very complicated chart. Let me explain what this is. The black dot is the portion of inflation in these different countries tied to shelter. Now I'm saying shelter rather than housing. Housing includes insurance for your house. It includes maintenance on your house. So look in the US, I said that was 40% is total for housing, but about 33% of that, 33, 34 is the shelter component, literally the thing you're in. So how do we calculate that? Well, the dark blue on this chart here is apartment rates. What are apartments renting for? And you can see it's a very small portion of how we do it in the US, but it's most of how we track housing inflation, which is a much smaller percentage in Europe, in the Eurozone, France, Germany, Italy, the Netherlands. In the middle there, that light blue is home prices. There are only 4 countries in the world that use home prices in conjunction with the dark blue, the apartment rates, to measure inflation. Instead, in the US, the UK, Japan, Norway, and Switzerland. So talking about the US here, we use this orange thing. What is this orange thing? Owner equivalent rent. The Bureau of Labor Statistics calls people on the phone and says, hey, I know you own your house. You're an owner. But what do you think it would rent for if you were to rent it out? Literally, that is how they come up with the housing inflation number. And they dial that same household back 6 months later, ask them again. And then 6 months after that, 6 months after that. So it's a different set every month, but they survey that group every 6 months. Anyway, the point is that's how they're guessing at what housing inflation is right now. And that's one of the reasons why it's not coming down. Overall inflation, with this being such a large portion of it and remaining very high, remember, as housing affordability gets worse, people aren't buying homes, they're renting them more and making owners feel like, hey, I can rent my place out for a lot more. And that is pushing up inflation in the US, the UK, Japan, Norway, and Switzerland. And stubbornly keeping inflation high. While it's coming down, it's not coming down as fast as we'd all like. And that's kind of where we are in inflation. So watching housing is really important. Already, energy prices have come down. Already goods prices have come down. We're now really waiting for these services prices to come down, which is really all about housing. But the way they do it, it's going to take some time. I think at the end of next year, we could be looking at 3 or 4% inflation, way down from where it is now. But it's going to take a while to get there. It's not going to drop dramatically despite what we're seeing at the pump or on store shelves. I just wanted to make that clear. So what are central banks doing to this? Do they know this? Do they understand this? How are they responding to it all? Well, they're aware of it. And I think a lot of central banks are taking some action here. So if you take a look at this chart here, this is the number of central banks hiking rates minus those that are cutting rates. So it's not just the Fed. There are 115 central banks around the world. And the dark blue line is the ones hiking minus those that are cutting. And you can see it's starting to peak out here, maybe starting to roll over. Those in blue are the countries hiking. Those in orange are the ones cutting rates. Believe it or not, there are countries cutting interest rates right now. China, Russia, Uzbekistan, Turkey, to name a few, are cutting rates. But it's starting to roll over. So they are starting to recognize that even though inflation is still stubbornly high, it's still too high. It's probably because of this housing thing, and maybe they're not measuring it great. And so they're starting to slow the pace of rate hikes. This is a really complicated chart, but I love it. So I'm going to explain it to you. This is going to be really important because this shows the stepping down of rate hikes by central banks. They're still all hiking rates, most of them, but they're doing it more slowly. So look up top, that's Brazil. So each one of these blocks is 25 basis points. So Brazil back earlier this year was hiking rates by 6 of those blocks, right? 150 basis points. And then they slowed to 100. Then they slowed to 50, and the last meeting they paused, right? That's that blank box. If there's no boxes in a column, it means the central bank didn't meet that month. But I've got a blank box there in October showing how they met, but they didn't raise rates. They stopped. Same thing was true in Poland. You've got Norway slowing from 50 to 25. You've got the same thing true in Australia, slowing from 50 to 25, maybe maybe not hiking at all in December. There's some question in the markets. The market forecast for December, somewhere between 0 and 25, not sure. Canada has gone from 100 to 50 to 25, to maybe 25 here, perhaps in December. The European Central Bank has started to slow down. The Bank of England may have started to slow down. The Fed has gone from 75 at the last meeting here for the fourth meeting in a row, hiked by 75 in November, but is expected only hike by 50 basis points in December. So they're stepping down, recognizing that inflation has probably peaked, at least in terms of the things that the Fed can control, central banks can manage, and now just waiting for that stubborn housing component to roll over. So they're starting to slow the pace of rate hikes. And this explains a lot of the rally in the markets in October and November. We're past the worst of it. Central banks are now beginning to slow down these rate hikes. Fairly good news, given that we haven't seen the economy fall apart yet. This is just a quick take a look at what we're seeing in terms of market performance, and it's maybe a little bit out of date at this point. This is from a couple of weeks ago, but the point was that those countries that have stopped hiking or slowed hiking first have seen the best performance in their stock market. Right, the stock market's welcoming this news that the rate hikes are over, and in particular Brazil, where they stopped, stocks are up 24% this year, where they've already stopped, right? Because they peaked out back in March. Norway, which is slowing, Canada, UK, Australia, all of them outperforming the US this year. I mean, getting back to this idea that international stocks are outperforming the US, particularly as some of those central banks stop hiking rates before the US does. This is where the market's expecting rates to go. So expecting that the Fed is going to hike a little bit more, maybe getting to 5% when they'll stop, and then looking at maybe the European Central Bank and saying maybe 3% is where they might begin to stop. But look, then they expect them to maybe cut rates. If I extended this further out through 2024, 2025, the market expects maybe one rate hike late next year, and then for the central banks to hold those rates flat for the next 2 or 3 years. Maybe, but that's never happened before. So look at this chart. I'm going to give you the history of this chart. So this looks at the last few years. Here's the last 50 years of that same chart. Look back to the 70s. We know inflation was stubbornly high in the 1970s, right? But what did central banks do? They hiked, but then they cut, and then they hiked, and then they cut, and then they hiked again. So very rare does the central bank hike and then keep rates flat. Usually there's a recession, things begin to weaken, and they cut rates. Already the market's expecting maybe one rate cut late next year. Could be more than that. I don't know. Hard to say, but there's some risk here that the central banks could begin to cut rates, pause early next year, begin to cut them, but then have to hike them again. Why? Well, China's been in a lockdown for the last 3 years. Their zero COVID policy has meant the economy has really suffered, particularly this year. China's GDP this year, its consumer spending is flat this year. Usually consumer spending in China is up like 9% every year. Alibaba's Singles Day, right? The biggest shopping holiday in the world, November 11th, Singles Day, blows away Black Friday, blows away Cyber Monday. Biggest shopping day in the world. Alibaba, for the first time in 14 years, didn't share those numbers, didn't tell us what the sales numbers were, because they probably expected they might have been a bit weak given the COVID lockdowns that are still taking place in more than 50% of the cities in China. More than 50% of the GDP of China is still locked down, movement restrictions, quarantine, big problems still in China. Now, China has announced in the last few weeks, given signals that they're going to reopen early next year. Everything from President Xi Jinping attending the G20 summit last week in Bali, Indonesia, not wearing a mask, first time. 2 months ago, he was at the Central Asian summit. He was in a mask. He avoided all public gatherings. Very different this time around, signaling that there are changes. They've released new rules around COVID protocols. They have scheduled the Formula One Grand Prix in Shanghai for April 16th. That's pretty soon. They've improved Paxlovid, which is an antiviral pill you can take. They've approved Pfizer and the BioNTech vaccine, an mRNA vaccine for now use in China. Previously, China only used its homemade vaccines, which weren't as effective. So China's embracing Western technology now, trying to get over this winter hump where we know respiratory infections tend to pick up, hopefully reopening in the spring. Great news. It's one of the reasons why Chinese stocks are up 24% just this month. The problem is this chart. The problem is 3 years of pent-up demand by Chinese consumers suddenly coming back in the second quarter of next year, just as central banks are expected to stop hiking. All of a sudden, the world's biggest consumer, 1.4 billion of them, start shopping again, pushing up goods and commodity inflation. And that might force central banks to not pause, not cut rates next year, but hike them even further, right? So I worry, it's not my base case right now. I'm watching it very carefully. It is an upside risk to inflation that would catch the market by surprise. This rally we've seen so far could be dealt a setback if indeed market begins to suspect inflation could begin to be revived globally by demand from Chinese consumers. So something to keep an eye on there, and why I don't think it's all over just yet. So what are the investment ideas before I get to your questions? How do we invest in this kind of environment? Well, the good news is, as I've already said, we're already seeing trends underway. We don't have to wait for the bottom, wherever the bottom is in the market, to change our investment strategy, to embrace different types of stocks. We already know if we've been rebalancing our portfolios and maintaining a diversified, balanced portfolio, done a lot better than just holding a handful of tech stocks this year, which are down 20, 30, 40, 50, 60%, depending on which ones you're looking at. Done much better than that. And I think we'll continue to do much better than that as we look out over the course of the next year or two. So what are the ideas? Well, number one is that short duration stocks are outperforming companies with more of their cash flow in the near term rather than those way out in the future. Value stocks, low price to cash flow stocks are doing really well. In fact, I just updated this yesterday. I didn't get it into the deck here, but in October, we've seen those shorter duration companies, value-oriented, low price to cash flow companies doing well, outperforming in the rally, leading on the upside. Just as year to date, they've done much better on the downside. And by the way, this has continued all the way through November. Really strong outperformance by higher quality companies with much more near-term cash flow, lower valuations relative to those cash flow. And these companies have been outperforming all the way back since August of 2020, when interest rates began to climb, and this became a more important factor to the market. I think it remains an important factor, again, outperforming on the downside this year and outperforming on the upside in October and November. This is a theme I think that's going to keep working in portfolios, and why I think you don't want to retreat back to growth stocks or those tech stocks that everybody's just hoping are going to be the ones that bounce back the most. They are not, and they are demonstrating that here in October and November. At least that's my view. Let me move on to another idea: high dividend paying stocks. Another way of looking at value stocks. This is complicated visual, but the charts on the columns up top are the difference between high dividend paying stocks in blue and the overall market in light blue. And the difference between the lines is down below in orange. And you can see in every single recessionary bear market, which is the time periods I've selected, high dividend paying stocks have outperformed, with one exception: 2008, 2009, the great financial crisis, where the highest dividend paying stocks, which were financial stocks, were the ones that suffered the most because it was a financial crisis. Very different environment this time. They're outperforming by a double-digit margin. So high dividend paying stocks, actually year to date, I haven't updated this chart. Year to date as of right now, zero. They are flat on the year, even though the overall market is down 17% year to date. So continue to see solid outperformance here. These two themes, more value-oriented stocks, meaning lower price to cash flow, and higher dividend paying stocks, are more prevalent in international markets than they are in the US. So not only can you find these stocks in every sector of the US stock market, the highest dividend paying tech stocks are outperforming the rest of the tech sector by a big margin. In every one of those sectors, these themes are working. It's working across countries as well, which is one of the reasons why on a fundamental basis, international stocks are outperforming this year. So again, a lot of these factors that are really benefiting a diversified portfolio. And finally, the laggards of the last 12 years, value stocks, high dividend paying stocks, international stocks, are really coming back this year, leading both on the downside and the upside, being the best performers in both when the market's going down and coming back up again. So let me wrap this up and get to your questions. Consider international. I know it's been a miserable place to be for like 12 years now. It is coming back. I think it's got legs here. Earnings for international companies were up 32% year over year in the third quarter. In the US, they were up 4%. And if you take out the energy sector is a big contributor to earnings this year for obvious reasons. And it's a bigger portion of international earnings than it is in the US. If you strip that out, international earnings up 12% year over year through the third quarter, -4% for the S&P 500. So better earnings growth, lower valuations, a lot going for international here. Short duration, high dividends working across the market within every sector. So those themes really benefiting a diversified portfolio, and focus on housing. Housing is the key to the inflation situation. Once we start to see those rental rates, owner equivalent rents, those phone calls begin to roll over mid-year, I think then we'll really start to see inflation come down in a meaningful way, allowing the Fed to pause, with potential risk of a Chinese consumer coming back in a sudden and big way in the second and third quarters of next year, potentially spoiling this downside drift in inflation. Not my base case yet, but a big risk I'm keeping a close eye on. So let me stop there, and Brad, let's see what questions have come in.
Okay, so yeah, thanks, Jeffrey. The good information. Definitely some things to think about. Thank you for the case on international as well. So that fits in well with our discussion topics with clients also. So again, I encourage you to use the Q&A function on the platform, and we will address your questions. We've got a few questions rolling in. Let's start with recession. So what are just common triggers of a recession? And then the term that was asked in the question is fractional reverse banking. And so that system, how might that play into triggering a recession?
Sure. Okay. So recessions always seem to have different triggers. Generally, we can look at the indicators that I had flashed earlier in the presentation, and they're an indicator of a vulnerability in the economy and the financial markets to a shock. Shocks are always different and frankly impossible to predict. I didn't see a pandemic in 2020, but in my 2020 outlook published in November of 2019, I said, I'm on Recession Watch. And actually the cartoon, I always use a cartoon, was a weather forecaster just showing these dark clouds over the globe and like, hey, over the next 6 to 18 months, I think we're going to get a recession. And we did. Again, I didn't foresee a pandemic, but I saw vulnerabilities to shocks. The PMI was down below 50. The leading indicator had dropped below 99. The yield curve was inverted. All those are signals that the economy is weak and vulnerable to a hit. And indeed, I thought it was going to come from trade. Frankly, there was a big trade war going on between the US and China, but it was also developing between, with Brexit going on, so many other factors. I thought it was going to be more trade related. It wasn't, but trade weakened the backdrop, and a variety of other things happened, and we caused that recession. So the catalyst is always different. But the vulnerability is always the same, and we have fewer vulnerabilities this time, but they were still showing up. So I'd say we're not as vulnerable, but still vulnerable enough to a recession. I think we're in one. Again, the shock. This time, the shock had to be inflation, right? It was tied not only to a sudden return of demand relative to supply. The supply chain problems were part of that lifted inflation. Then the sudden war in Ukraine further jacking up prices. All of that, constituted the shock that catalyzed the vulnerability. Fractional reserve banking is essentially where the banking system makes money for the economy, right? So the idea is that when a bank makes a loan, it only has to hold sort of a portion of the value of that loan in reserves with the central bank. And so when there's a lot of demand for borrowing, money can grow very rapidly. And so the Fed tries to limit that by raising the cost of reserves for banks, meaning that it's more costly to make loans for a bank. So the bank would slow down, be more hesitant to make loans, meaning they'd raise the interest rate to make it more profitable, to justify the additional cost, or they would just simply make lending standards tougher. We've started to see that, meaning it's harder to qualify for a loan, higher FICO score, more down payment, better credit overall, and just reining that in a little bit. And that slows the economy. Why does it slow the economy? Because borrowing is the fuel, man. It's essentially borrows growth from the future. If you're borrowing money to spend today, you're not gonna have it to spend in the future. And so essentially it juices the economy in the near term. And so the more we see banks creating credit and creating money, it means the economy grows. So when the Fed lowers the cost of reserves for banks, and that's what they do with lowering short-term interest rates, it encourages banks to make more loans and juices up the economy a little bit, right? But when they're raising those interest rates, they're increasing the cost to make a loan by a bank, so the banks are more hesitant to do that, and that slows the economy. That's an overgeneralization a little bit. That's kind of how it works. And so it's really what the Fed's trying to do right now, slam on the brakes as hard as they have in many, many decades, and getting banks to stop making loans to really tighten up and curb demand, which is, what's so outstripping supply right now and causing prices to go up. It's not a perfect process, and usually results in a recession because it's very hard to fine tune. And so the Fed tends to overdo it. And I think they've likely overdone it this time.
Yeah, and so you've got a couple questions related to that. So, we, can debate whether they were late to the game or not in raising rates, but they certainly have been aggressive in raising rates. Do you have any concerns that they've overshot and the recession could be deeper than maybe we're maybe thinking at this point? Somebody even asked about a depression as well. But do you feel like maybe they've gone too far, or there might be more damage than maybe we realize at this point?
Well, so far, in general, when we worry about them going too far, we worry about something major break, a financial stability issue. And, we've heard about FTX, right? So there's been, some fallout in the most liquidity sensitive, the most money sensitive parts of the market. I mean, literally, crypto is just simply driven by liquidity, right? It's a liquidity reservoir. When there's so much money sloshing around the global system, it absorbs it. And when there's not enough, it releases it. And that's exactly what happens. Crypto has crashed because liquidity is then, being drained by the Federal Reserve and needed in the rest of the economy. And we saw a little bit of structural risk with the UK bond market back a couple of months ago, but that was not so much tied to rate hikes. It was tied to a change in government and a change in policy, to sort of an unsustainable fiscal mini budget that caused the bond market to overreact. I think that none of those are really structural risks. And already we're past most of it, right? We're past the peak in rate hikes. They're starting to come down, and we haven't seen that type of structural breakage that would normally go along with a central bank going too far. So I think the good news is we're already starting to see a step down. Markets are pricing in maybe 2 more rate hikes by the Fed, maybe 50 in December, maybe another 50 or 25 early next year. And then they're pretty much done. And that's encouraging that we're through the worst of this. We haven't seen any breakage yet. Maybe we will, but I think it's more concentrated in those areas of the market that are very liquidity sensitive, again, like FTX, like crypto, like NFTs. That's where we really felt the brunt of it. And in general, consumers still look to be pretty solid. Their balance sheets look pretty good. Housing, yeah, we're in a housing downturn right now, but there's still a housing shortage, right? So it's harder to buy a home, but there's still enough demand, and we're still seeing home prices remain fairly stable and construction activity continue. So we're not seeing a big fallout there. Banks are more capitalized than they've ever been, so we're not seeing any financial systemic problems in the banking system. That's incredibly important. And so what I'm seeing is not the type of problems that usually come along with a Fed going too far, as they did in 1998 and a number of other times. So we're not seeing that yet. That said, they're not done, right? So maybe they can't just hike 2 more times. Maybe they have to hike a number of more times because of China and that return of demand. That would greatly raise the risk. I think already the bond market has already decided that they've done enough, and yields are starting to decline in response to that. So, I don't think a depression is in the cards. I think this is going to be a fairly mild recession, though longer than we'd like. Already, I'd say that we're, at least globally, we're 1 quarter into this now. I think if you look at the US, which already had 2 negative quarters of GDP in the first half of the year, we might be 3 or 4 quarters into US recession. We don't know because the date hasn't been set yet. And we might have two more quarters to go. So it might be a 6-quarter recession. Compare that to 2 months back in 2020. So it's going to be maybe longer, but shallower, which doesn't feel good, but is maybe means we have less of a depth of the downturn, meaning fewer job losses and fewer less destruction of capital.
Yeah, and certainly, like you said, the 10-year Treasury is already indicating that what you're just stating. So let's maybe pivot to, we've got questions coming in. Of course, we just came off of the elections, midterm elections, and that's still kind of shaking out, but it looks like we're going to have kind of a split parties in Washington. So any comments around that? And then also I'll maybe add to this, there's a question about higher rates and the servicing of debt as well. And so how might that play? How would the government react to that? What are some of the tools at their disposal as they pay higher interest rates to service the debt? How might they react to that?
So a few things there. One, I'll just say, in terms of the election, obviously the outcome of gridlock, essentially, and from a legislative perspective, stock market tends to like gridlock, in that it means there's not likely to be sweeping legislative change in areas that are sensitive to that, like energy or healthcare or financials. So companies have greater visibility on their earnings outlook, and not having to maybe adapt to new laws coming into place. So generally markets like that. The risk this time, though, I think is, if we look back last time, we had Republicans in control of the House and Democrats in control of the Senate. We had a couple of major issues with the debt ceiling back in 2011 and 2013 that resulted in, it really did affect the markets, the bond market more so than the stock market, but both were dramatically affected by a showdown over the debt ceiling and the potential risk of at least a short-term default on US debt. That was a big risk. That could come back into play again here with the same type of matchup. It also corresponded with a big pullback in government spending. So we'll have to see whether that happens. Austerity isn't so much an issue with the Republicans this time as it was back in 2011, 2013 with that huge budget. They seem to be more okay with it this time, but we'll have to see what the shakeout is. That is one big thing to watch. I know the Democrats have talked about maybe trying to push through a debt ceiling increase in the lame duck session here, because they know it's going to be an even tougher thing to do next year, but I don't think they have the momentum to get that done. We're watching that very closely. Mike Townsend, our head of legislative affairs in Washington, is right on top of that for us. We'll keep you informed. Regarding the debt, I mean, the thing is, servicing our debt is still very low cost because we termed out so much of it. We financed a lot more of it on the long end. So the U.S. Debt interest payments as a percent of the budget, still pretty low, but that is going to go up, obviously, as we roll over a lot of debt here at some higher rates. Is it affordable? I mean, I guess, the market believes it is, because interest rates haven't shot up too much higher to suggest that there's some kind of now risk premium to those payments. But, all I can do is look out to what other countries have done to say, what do other countries do when they have so much debt, more than 100% of their GDP tied to externally owned government debt? What do they do when those interest rates start to come up? Well, there's only 1 or 2 other countries to look at. One is Japan. Japan has way more debt relative to the size of its economy than the US does. And interest rates have started to creep up there as well. How do they afford it? And one of the ways they've done that is, well, for over 20 years now, they've implemented zero interest rates. So they had zero interest rate policy. They started in 1999. We adopted it in 2008. Then, to try and push down longer term interest rates, they started doing QE in 2001. And sure enough, 8 years later, 2009, we adopted QE, quantitative easing, to push down long-term interest rates. In 2016, Japan adopted yield curve control, YCC, which essentially says we're just going to manage the entire yield curve and we're just not going to let interest rates ever get over 0.25%. Just going to pin them there, period, at whatever cost. And that's what they've done. Maybe 8 years later, that would be 2024. Maybe we have to do that too, and essentially pin long-term interest rates to a certain specified target in order to be able to afford the amount of debt that we have. What happens in that scenario is the currency plunges. We've seen that with the yen. Since they've implemented yield curve control, particularly this year, the yen has plunged versus the dollar and other currencies as well, because when you're stuck only getting 25 basis points on your yen-denominated debt, well, then the yen has to plunge in order to make it attractive to foreign investors to buy in and hold that. So, essentially boosting the return by basically getting a discount on the currency. So if you watch the dollar, that might be an indicator that the U.S. debt situation is becoming unsustainable. There's no sign of that yet. Dollar's up 12% this year. So the market's saying absolutely no problem with this rise in interest rates and all the debt that we have, not a worry. But I'm going to watch that very closely. I think the dollar maybe has peaked out or maybe near a peak, and it might be beginning to slide next year. We'll see how fast that happens and how much of an urgency there is to managing the amount of debt that we're growing, the size of our deficit, and then what rate we're paying on all that debt.
All right, perfect. We have a number of questions that are coming in that I would say are more related to the person's individual situation. So I think, Amy, I'll work with you on finding a way to respond to those questions. We've got just a couple of minutes left, but I would love to hear your thoughts. I've got a number of questions here around cryptocurrency and certainly the activities that have been going on around that in the last week or so. But just any final thoughts on crypto in general at this point and what you see going forward?
I think there's a very strong use case for central bank digital currencies, meaning a digital dollar issued by the Federal Reserve. Already we're seeing this in some countries around the world that are ahead of the U.S. in putting their digital currencies out there. There's already like the sand dollar. There's a few others that are leading the way, and I think it makes a lot of sense in terms of what it means for the banking system. That said, it becomes a very effective means of exchange, right? Like currency. Less attractive and interesting as an investment because it becomes a much more stable. In order to have a currency, you want that currency to not dramatically change in value every 10 seconds. So I think as it becomes more useful, it becomes less sexy as an investment. And so while I think there's still, maybe a marketplace for crypto and NFTs, very much more in this form of a liquidity-driven kind of intangible collector's market, as opposed to actual means of exchange. I think 5-10 years from now, we'll all be using digital dollars, in the way we use PayPal or Zelle or whatever these days. We just won't notice that it's an account with a Fed, not with a merchant bank. And I think there's a very strong case for that. But that said, as an investment, I think investing in the infrastructure of all of that then makes some sense, perhaps. But maybe in blockchain and all those things are very interesting. But I think in terms of the currencies themselves, I think they're going to get a lot less interesting and in terms of their adoption. And we'll see those central bank digital currencies really take their place.
Yeah, that makes sense. All right. Well, we unfortunately couldn't get to all the questions that came in today, but we are up against our time, and we made it through. No hurricanes, no tech issues, so it was good. And thank you again, Jeffrey, for joining us. And we always enjoy your comments and your perspective. And that will conclude our call for today. But everyone, have a great Thanksgiving, and we'll meet up with you again sometime in the future. Thanks a lot.